Hello, welcome to the Foster Swift webinar on the topic of planning to ensure full forgiveness of your PPP loan. I'm Mindy Johnson, co-group leader of our business tax group at the firm and also one of our benefits attorneys. Joining me today are two of our business attorneys, Michael Zahrt and Taylor Gast. Mike and Taylor and a number of attorneys at our firm have been addressing a whole host of questions related to PPP loans and their forgiveness. And so the goals of our webinar today are to provide clarity with regard to the rules that apply, identify areas for which guidance is still expected and anticipated, and also provide a few items for your consideration in analyzing these issues. The information provided as part of the webinar today will be very general guidance. We recommend that you speak with your own individual attorney to apply and analyze how these issues affect your specific circumstances. Just a couple of items for housekeeping as we begin. I want to let you know that we are recording this webinar and a link with the recording will be emailed to all participants after we're finished. The link will also be posted on the Foster Swift Coronavirus Resource page later today. Additionally, Mike and Taylor, after their presentation, will handle a variety of questions. We've received a number of them from potential registrants already, but have also enabled the question feature to be used during the presentation today. Given our 1 hour time frame for this webinar, we appreciate that not all of your questions will be answered, and Taylor and Mike will strive to address a variety of questions on the topics that we're speaking on. But you are welcome to contact any of us afterwards to address the questions that you have. So with that said, let's get started. Taylor, the floor is yours.
Thanks, Mindy. Welcome everybody. I know this is a really hot topic right now. We have a lot of clients we've been speaking with and businesses who we've been speaking with that they've been looking at how loan forgiveness works, and they have all sorts of questions and relatively little guidance. And so what we've been doing is kind of making our best effort to read the CARES Act, understand the rules, read all of the guidance that's been coming in the last several weeks, and stay on top of all of this as it's changing daily, literally daily, hourly in some cases, and distill it down into what we hope is a really helpful presentation. Like Mindy said, some of these are really fact-specific questions, so we're going to give some examples here. Some of them will be fairly general in nature, and we would really encourage you to reach out with kind of your specific scenario kind of questions, to make sure that you're kind of properly calculating, your loan forgiveness on the front end here to the extent that we can. Be sure of that and be ready to go basically by the end of this 8-week period to apply for loan forgiveness. So I'm going to kind of jump in here, and we've got a lot to cover. So we're gonna start here with the basic rules on loan forgiveness, and the sort of 5 bullet points we have there are actually, I would say, in a general sense, not all that complicated, it seems, from the beginning. So those basic requirements are, as you can see, satisfying the eligibility rules and certification requirements. Touching on this one real quick, we've had just a wave of questions in the last couple weeks regarding the certification requirement in particular. And you may have seen a Treasury and SBA published frequently asked question that relates to one of the certifications that you made when you applied for your PPP loan. And that certification basically said that current economic uncertainty makes the loan request necessary to support your ongoing operations. And in recent guidance, we've received some additional clarification that we should be in particular, if we are a public company, we should have a bit of concern as to whether we can qualify and make that certification in general. And, whether we are a public company or not, whether if we're a private company, for instance, we should be considering some additional factors like our liquidity picture and the business's ability to currently operate. Now, this has led to kind of a whole host of questions, in particular in light of some related penalties, potentially for making knowingly false statements on the application, and the potential negative repercussions if we've made a misstatement or made that certification and it was not in good faith, for instance. And the recommendation here is to take a really close look at the wording on the certification. We know, for instance, that the CARES Act suspends the requirement that the borrower, or that the applicant at least, has not sought credit elsewhere. So that is a easier to meet requirement here, but at the same time, we want to make sure we have something in our file that we have recorded this decision, that we've recorded the reasoning for this decision, and that it's really been made in good faith and is justifiable. And we're going to talk about why that, recording that information is particularly important a little later on, particularly for our large loan borrowers here, and the fact that any loan over $2 million is going to be audited without a doubt, and some others will as well. But the important thing here is that we are able to kind of have a defensible position on the back end when we're applying for loan forgiveness. So we have a lot to cover, and honestly, that bullet point alone could be its own potentially a 30 to 60 minute conversation, and I've had them. So I would, again, very fact specific, I would encourage you to reach out on that issue if you have any questions at all. We've been having a lot of these conversations. So other basic requirements for full loan forgiveness. We need to spend all of the loan proceeds within the 8 weeks after loan origination on permitted forgivable expenses. There's a distinction there between permitted expenses and forgivable expenses, but the point I want to hit on real quick on this bullet here is the idea of that 8-week window. We receive a lot of questions about the 8-week window, and the 8-week window begins on the date of origination, which Treasury has clarified to mean the date that the loan proceeds were first deposited. I haven't seen too many situations where there was some sort of multiple deposit situation, but regardless, the clarification here is there's no choice in terms of when we start the clock on our 8-week window. It begins on the date that the loan proceeds are deposited. And so that can be a little tricky as we start getting into some of the forgiveness reduction calculations and thinking about whether, for instance, can we get employees back on payroll? How do we pay them so quickly, and not knowing when the loan proceeds are going to be deposited? We have some flexibility in these calculations, but at the end of the day, I think the important point here is we don't have a choice. The clock starts when it starts. Next basic requirement is that we retain employees compared to pre-COVID-19 employment levels and headcount, and we'll get into that discussion shortly. So I won't belabor that point too much here, because we will shortly. Another basic requirement is that we don't reduce employee wages by more than 25% compared to pre-COVID-19 wage levels. And finally, we need to make sure that we are spending at least 75% of the loan proceeds on our payroll costs. And again, we're going to dive into, in particular, those latter kind of, I think, 3-4 requirements here as we go along. So I'm gonna move on to our next slide here, and we'll start kind of diving into some specifics for us. I think Michael.
Thanks, Taylor. So what are the permitted expenses? And as Taylor said, there is a distinction between permitted expenses and forgivable expenses. So we'll get into that here. I guess before we do that, I do see the Q&A kind of blowing up down there. I see some chat activity too. We do see that. We are saving time for questions at the end, so we'll go through and hopefully get to as many of those as we can. We've got a hard cutoff of 11:15 this morning, so I don't know if we'll get to all of them. If we don't, obviously, please reach out to us and ask those outside of this meeting. But we do see them. We're not ignoring you. We'll get to them at the end, but we want to make sure we get through all the material too. Just a little housekeeping note there. So what are permitted expenses? They are payroll costs, and we'll dive into that more deeply on the next slide because that is a thorny issue. Interest on a covered mortgage, and the Act has covered mortgage, covered rent, covered utilities, and in all of those situations, what they mean by covered obligation is one that was in existence prior to February 15 of this year. So if you've got a new mortgage after that date, or you've moved and you've got a new warehouse that you pay rent on after February 15, those are not permitted expenses. We're only talking about pre-February 15 numbers, and that's kind of the quasi-arbitrary date that they picked of, when did this COVID-19 crisis start? So keep that in mind when you're identifying your permitted expenses. Those are also your forgivable expenses: payroll costs, interest on covered mortgage, rent payment, and utility payments. Now, those are your forgivable expenses. And additional permitted expense is interest on pre-existing debt obligations. The important distinction there is that it is not forgivable. So you can use your loan on those things, and if you want to use it as a line of credit, that's fine. This is a cheap line of credit, right? It's 2 years at 1%. So it's not all bad if you keep this money. The purpose of this webinar is planning for full loan forgiveness. So everything in this is kind of geared toward making sure that you spend the whole thing in 8 weeks and get the whole thing forgiven. But if you don't, it's not a bad fallback to have what's essentially a super cheap line of credit. But those pre-existing indebtedness obligations are non-forgivable. So if you've bought equipment on credit and you've had accrued interest on that, that would not be a forgivable expense. Think about vehicles and other things that don't fall into those prior 4 buckets. You can use your loan proceeds on them, but you'll be paying interest because it's non-forgivable. So that is the first important point. The second is utility expenses. The Act defines utilities as gas, electric, phone, internet, and water. I think it's reasonable to interpret phone expense as your office line and your cell phone lines. There are additional questions though of what else can we pack in there. Be cautious there. We think of some things as a utility is kind of a no-brainer. I think like trash service, it's kind of a no-brainer utility, but it's not in the statute, right? So other things might be a closer call, like your lawn service, snow removal. Those types of things are vendors, and might appear to be kind of a quasi-utility, but it's not in the plain language of the Act. So the advice there is to be conservative. If you're planning for full loan forgiveness, try to plan to hit the full number with other expenses that are a slam dunk. And if you get to the end of your pro forma analysis and you're not quite there yet, maybe then you take a more aggressive risk position with these other utilities. A special note for those of you who are self-employed, if you want utility payments to be forgivable, you must have taken them as a deduction on your 2019 tax return. That's the same thing for rent and other business expenses. So kind of a special carve out for you self-employed folks there. Be wary of that. And then one other note here is just about how the rules function for accounting purposes. These are all cash basis items. So we'll get into this more detail later, but there is some ambiguity about the plain language of the Act. And the plain language states that permitted expenses must be incurred and paid during that 8-week covered period. So obviously the plain language, incurred and paid, clearly it's cash basis, it's not an accrual basis. But what does this incurred language mean? Can you prepay health insurance premiums? That seems like it's a question now because you haven't really incurred them during the 8-week period if you are prepaying. So that's another area of ambiguity to keep in mind. Again, if you can achieve full loan forgiveness without prepaying those expenses, the best practice is take the conservative route. You've got the slam dunk. If you're not quite there, maybe we talk about taking a more risky position. So with those big buckets out of the way, let's take a deeper dive into payroll costs and what exactly is included in those. We get a lot of confusion on payroll costs between that 75% test and the wage reduction test, right? So you've got to spend 75% of your loan proceeds on payroll costs, and that's this. And it's distinguished from wages and salary and that type of thing. Wages and salary are included in payroll costs, and wages and salary are what we focus on for test 2, but the payroll cost bucket is a much bigger bucket than just wages or commissions. So let's make sure we get that distinction straight when we're looking at the test, because I've seen some confusion there. And this slide gives us what is included in payroll costs. It's salaries, wages, tips, all of your benefits, group health plan benefits, retirement benefits, and state and local taxes. A brief point on some of those leave benefits. As a general rule, those are included in payroll costs, but as you're all likely aware, the Families First Coronavirus Response Act gives some essentially FMLA leave to folks that are either diagnosed with COVID or taking care of kids who are not in school, that are closed due to COVID, and it provides essentially a reimbursement to employers for providing that sick pay for those folks. If you are taking advantage of those tax credits under the First Response Act, those are not considered payroll costs. So kind of be wary there. There's a lot of moving parts to this. So be wary of the folks who are taking that additional paid leave. Those would not be included in your payroll costs. One of the questions we got beforehand are contributions to SEP and profit sharing plans. We don't have a ton of guidance on what is included in retirement benefits. We think it's a broad bucket. We don't think that we're going to distinguish too much between what type of qualified plan you have, as long as it's the employer portion of the contributions to that plan. We think as a general rule that should be includable in payroll costs. My one bit of caution there is if you have a SEP IRA for a self-employed individual, you probably want to be careful not making too generous of a contribution to that. We have guidance in the interim final rule that applies to self-employed individuals that Congress does not intend for these PPP dollars to be a windfall. So, I don't think that you want to take the position that, hey, I'm just going to dump a whole bunch of money into my own SEP. I'm going to count that as payroll costs. It's going to be forgivable. I think that in all likelihood, the IRS is going to look at that as kind of essentially the same thing as a bonus. And the rules applicable to self-employed individuals limit the amount of compensation that you can pay yourself under PPP dollars. And if you try to do an end run around that and dump it into a SEP, I think you're going to get dinged. So, again, the rules on this are, be reasonable, be conservative until we get more guidance. And if you think you need to take a riskier position to achieve full forgiveness, and if that's the end goal you want to meet, give me or Taylor a call and we can kind of help you gauge that risk analysis a little better. One final note on this slide, taxes. We get a lot of questions on federal taxes. What counts, what doesn't count? So I think it's easiest to view it as, look at your 941, and when you're determining the wages paid to your employee, those are on a gross basis, right? So the amount that your employee actually gets in their check is much less than their gross wage number. And that's the number you use when you're calculating salary, wages, and all that type of thing, right? So you've got your employee's wages, you're going to back out federal taxes, you're going to take out their portion of FICA, state and local taxes. So you don't have to reduce payroll costs by those amounts. You use that gross number, right? So in that respect, the employee portion of payroll taxes are kind of included in that payroll cost number. But the other side of that coin is that you don't get to include the employer contributions to those payroll tax amounts. So the employer portions of Social Security benefits and that type of thing are not included. So that's what we mean by certain federal taxes are not included in payroll costs. Treasury has a long question and answer page that grows by the hour, it seems. So if you want to take a closer look at that, they do actually a really good job of explaining it and giving specific examples. That is FAQ 16 of that document. So with that out of the way, now we know what our permitted expenses, we know what our payroll costs, we know what our forgivable expenses, we kind of know what we get to spend the money on. The next step is making sure that we spend those in a manner that achieve full forgiveness. And the first test we're going to look at is this employee census test.
Great. So like Mike said, we've got, and as we kind of mentioned up front on those basic requirements, we're on our kind of third basic requirement here. We've talked about eligibility and certification briefly. We've talked about like Mike said, what we can spend the loan proceeds on. And now we have basically three ways, well, two calculations and tests where we can reduce loan forgiveness, and then one additional rule on top that we'll get to towards the end here. And so it's really important. I'm just going to kind of talk generally here for a moment about the two loan forgiveness reduction calculations, and we're calling them test 1 and test 2 on our slides here. I think it's really important to think about these as separate requirements. Keep them separate. Don't, frankly, keep them in totally separate buckets. Apply one, apply the other. And there's no overlap. You cannot offset one by doing particularly well on another. We've had lots of conversations about how these two interact, and frankly, my advice has been apply them separately. Keep them just totally distinct. They do interact. They're, you know, in general, we're talking about employees and how we pay them and whether they're on payroll. But just a note of caution there, if we're thinking about trying to, you know, how we might be able to offset doing well on one with one of the other tests, it doesn't quite work that way. So in any case, the first test here relates to our head count and our employee census, if you will. And the basic point here is that we need to retain or rehire our employees as applicable during that 8-week window. And so if we kind of just want to think about what is this test trying to accomplish in a general sense, we are looking at the 8 weeks after loan origination and our just total employee census. And we're comparing back to a prior window of time, a look back window, and asking whether we have had a reduction in our employee headcount. And in general, that's a pretty, you know, straightforward concept. I think it's pretty easy to understand, but we have a number of points here that are, you know, there are details to make sense of that are in some cases a little unclear based on guidance. And so we'll walk through kind of our sense as to the calculation here. I'll say on these two calculations in particular, and the final 75% test that we'll hit on, if there's any area that is the most in need of clarification, these are it. Probably the second one even more so, but it will not be surprising, and we definitely expect to receive additional guidance on forgiveness in general. It will be not surprising at all if the additional guidance that Treasury issues comes in the form of interim final regulations that provide some very significant clarifications and maybe even changes to these. So the point here is to be able to develop kind of a forgiveness model, run your numbers initially, be able to understand how this is impacting our decision to use the loan proceeds during our 8-week window right now, because we're already spending them without this additional guidance. And then as we get more guidance, let's be updating that and making good decisions based on the information available at the time. So jumping into the actual test and the mechanics here. Step 1 is to determine and calculate kind of our average number of full-time equivalent employees during the covered period, and that covered period being our 8 weeks after the loan proceeds were deposited, divided by the prior average full-time equivalents. And, you know, the big open kind of question, concern issue here is, you know, how do we get to that FTE, the full-time equivalent employee number? I'm going to hit on that on the next slide, but just note that that's up for discussion a little bit. For our purposes, we're gonna roll with kind of a 30-hour per week average, and I'll add some clarification on that in a moment here. But basically what we're doing is we're taking this look back window, and if we drop down to that third bullet point, we have two time periods in which we can judge the look back window. We have February 15th of last year through June 30th of last year, which is kind of an odd window of time because we're talking about average monthly levels of full-time equivalents. So you don't even have full months, but in any case, we would get the average monthly FTE number for that window of time, or we would use this year, and that would be January 1st of this year through the end of February of this year. And you are permitted, you're certainly permitted to look at both. In fact, I think it's probably a good idea to just double check, even if you think you have a sense of which would be, the preferable number here is going to be one that's lower because we're talking about our, denominator here. And so, the recommendation here is run both numbers, find the lower, and then we're also going to compare against our average during the 8 weeks after loan origination. And that's going to, in most cases, if we've reduced the amount, if we have a lower number during our 8-week window than we had during our look back period, then that's going to result in some fraction that's less than 1. And so that would be, let's say we have 80% total FTE levels. We're going to multiply that 80%. We're going to take 80% of our loan amount, of our loan amount, and that's going to, be the reduced loan forgiveness amount now. So we would reduce it. So to put kind of an actual example and real numbers to this, let's assume that our company here takes a $350,000 PPP loan, and we expect 13 full-time employees and 6 part-time employees to work 15 hours per week during our 8-week window. Now, we are again, like I said, we're using kind of a 30-hour per week average on this, and that is not by any means final, to be clear. We are making kind of a projection and guess, to be honest, based on other citations within the CARES Act, which is where these PPP rules largely stem from. And elsewhere in the CARES Act, we have a reference that gets us to, some ability to project that, there's a good chance we're going to use this average, 30-hour per week average. But it's entirely possible that will change. So I just want to make sure we're all on the same page here as to that. And similarly, there's this kind of concept based on the same citation that we can use kind of a fractional approach and in viewing our part-time employees. So the way that this would work, assuming that this is the approach in the final regulations, is to first count all full-time employees as one full-time equivalent employee. So in our case, we have 13 of those. And then as to part-time employees, we take this fractional approach that I mentioned. And so we have part-time employees working 15 hours per week. And if they're all working 15 hours per week, that's half of, a full-time employee. And so they all get added up as a half. And we end up with 3 FTEs. Adding those together back to our 13, we have 16 FTEs. And so when we look back and let's make some more assumptions here or throw some facts in, we have a monthly average of FTEs in our earlier look back window that was 20. We have a monthly average of FTEs in our more recent look back window for this year that was 23. As if you run the numbers and do both of those, you'll have a higher percentage to work with, a fraction that's going to reduce our loan amount by less if we take that 20 number. And so we would, at that point, there's really not much of a decision to be made. If let's say we were at the end of our 8-week window and we're running the numbers, we would say that we're just calculating this. It's 16 divided by 20. That as a fraction, we multiply against our $350,000. we get now a maximum forgiveness amount of $280,000 pending our other loan forgiveness rules and calculations and working those in. Now, because we're early on in this window and you know, mathematically speaking, nobody listening here is all the way through their 8-week window. We have options. We have potentially ways that we might be able to manufacture a better result. And you know, we have ways that we can think about you know, addressing that issue. And the main option here is how can we get more employees back on payroll? Can we hire some additional employees? How can we get those numbers back up? And that's a question that we're happy to talk through with you. But in general, it would be kind of a rehire discussion. And I want to touch on just a few things in terms of that rehire issue here. We've received some clarification from Treasury recently in the SBA as to how some of this works, and we're still waiting on kind of a lot of additional clarification as well. One clarification that we did receive notes that to the extent that we have provided an actual offer to rehire employees and previous employees, and they decline that offer, I'll add some color on that, but if they decline that offer, it's not going to impact and hurt our forgiveness as it relates to this issue. So that's helpful. There's some color on that though. We need to make sure that, for instance, the offer was made in good faith. We need to make sure that the offer was written. And we need to document the fact that the offered employee rejected our offer. And all of those are really important. I would really strongly recommend that we, you know, have a discussion with one of our employees here, one of our attorneys here who understand this rule, and just think through what that written requirement means and document that so that we're set up on the back end when we apply for loan forgiveness to have no questions or concerns, and we're within that frequently asked question allowance and what will hopefully be added into kind of the final rule on loan forgiveness. One additional, and you know, one of the probably stickiest pieces, you know, for me as I've looked through and I think probably Mike would agree as we've looked through the CARES Act and understanding what the rules are here. There's this, and you may have heard about a June 30th period of, you know, time before or by which, if we've rehired employees and we have gotten everybody back on payroll, there may be some, you know, some allowance, you know, to not hurt our forgiveness picture. And what does that mean? And, you know, I've seen everything from, hey, you can hire, you know, summaries out there that say everything from you can hire people on, you know, June 29th. And if we bring them all back and they're back on payroll, we should be good to go. You know, I think that's that could be a very risky, aggressive position, to say the least. I would not recommend just relying on that position. I think it's tough to think that that's going to be the rule, frankly. Our recommendation, frankly, is to somewhat set aside that June 30th window, or at least, again, have the discussion, make sure we're making a really informed decision about what that actually means, because we have two loan forgiveness calculations here. None of them relate to a June 30th window of time. The June 30th window is mentioned a few times. I mean, it's the last day that you're technically able to apply for loan forgiveness, for instance. I'm sure the money is going to run out before then, so that's not particularly useful. It comes up in a couple other ways, but it really doesn't relate to our forgiveness window in a lot of ways. And we still have these two loan forgiveness reduction calculations, and we really highly recommend that you take a close look at these two calculations, one of which we've talked about, the other we're going to get into in a moment, and take them seriously and not just rely on this June 30th kind of an idea. Last item I'm just going to hit real quick. We've received a lot of questions about whether we can lay people off and you know, how the rules work after our 8-week window as it relates to this headcount number. And as we see it, there's really not much that regulates the window of time after that. Let's, again, if we have questions about it, feel free to reach out. But in general, the CARES Act really isn't doing a lot to regulate you afterwards. Now, there could be additional rules that come out on this point, but that's kind of the base, level that we're at right now. So with that, we're gonna talk about the second test here and dive into the wage reduction test.
Thanks, Taylor. One other question I get on that first test before I get into this one is that for those full-time employees, those people you have that are working over 30 hours a week, they're just one, right? You don't get to use their extra hours to make up for, an FTE number. And obviously we're using that 30-hour number because we think it's right, but we don't have clarity on that issue. But the point being, if you've got, if you are an employee of your business, you can't work 60 hours and be a double FTE, right? Once you cross that full-time threshold, you're just one, you're not 1.2 or whatever. So I get a few questions on that. It helps to kind of identify who your full-time people are using that full-time standard of 30 hours a week, count them as one, look at the rest of your pay register for people who are under that threshold, then do your FTE calculation, then make sure you're not getting, a more than one FTE person. So with that, I'll move on to this miserable test. Taylor, before we were talking before we did this webinar and kind of splitting up the slides and how we want to do it. And Taylor was very nice about, he didn't care which one he did. He kind of said, I'm happy to start if you want. And I think the reason he did it is because he knows I hate this test. And it would just make for an entertaining webinar if I had to talk about the wage reduction test. And the reason I don't like it is because it is so ambiguous. My favorite class in law school was contracts. And one of the things we learned in contracts is the legal definition of ambiguity. And a term is ambiguous under the law if it is reasonably susceptible to more than one interpretation. As I read the plain language of this second test, I think it's reasonably susceptible to 3 interpretations. And then when you go down the rabbit hole on any 3 of those, they reach just absurd results. So if there's any area that needs more clarification that we haven't got yet, it's this test. So what we're going to show you today is what we think is the most reasonable position. We think it's the most conservative position. So we think if you kind of go by what we're talking about today, you should feel pretty comfortable that you're going to satisfy test 2, and you might even over satisfy test 2. But until we get that additional guidance, we'd rather have you over satisfy it and then maybe have to make an adjustment, in hopefully soon, but maybe in a couple of weeks when we get clarification, then under satisfy it, and then you've already spent the money and it's gone somewhere else. So that's our approach to test 2. Let's look at what it says. It says the forgivable amount is reduced dollar for dollar by the amount of any reduction in salary or wages for any employee that is greater than 25% compared to their wages in Q1 2020. Couple of notes on this general rule. If you've got folks that make more than $100,000, they're excluded from this rule. The plain language seems to be that they're just completely excluded. You could reduce them down to 0 and it doesn't matter. I think the reason being you're not likely to do that for those high count people anyway, but they are excluded. Also, people are excluded, the people Taylor mentioned, the people that were on layoff, you offer to bring them back on the same rate of pay, same hours, same position as you previously offered them, and they decline, and you document all of that in writing. That FAQ is very clear that they're excluded for all purposes of loan forgiveness calculations. So not just for your head count test, but for this test also. So that's helpful. I mean, there's a lot of people that think I'm better off on layoff, I'm making more money on unemployment, so I'm going to go ahead and decline. What those people need to keep in mind is that if you offer to bring them back from layoff and they decline, they're no longer unemployed, they quit. So they don't get unemployment benefits and they don't get their wages, they've quit. And the FAQ from Treasury agrees with that position. It has this little disclaimer like, note, hey, if you decline, you might be blowing your unemployment benefits here. So that's something to communicate to your employees. If you need to bring people back to satisfy these tests and they say, I'm better off on layoff, you can say, look, I'm sorry, but we want this dollars to be free dollars. We've got to bring you back. And if you don't come back, you're not getting unemployment either. That's an employee morale issue, obviously, for you to consider. But from a test satisfaction perspective, to me, it's pretty black and white. A couple other notes here to to consider. It is reduced on a dollar for dollar basis. So test one creates a quotient. You multiply the quotient by your entire loan amount, and then that's the new capped forgiveness amount. This operates completely independently. So our last test, we had a $350,000 loan that was reduced to $280,000. If I do not satisfy this test by $30,000, now my max forgivable amount is down from $280 to $250. So they operate independently, and you can get double dinged on forgiveness if you fail both tests. And it is on an employee by employee basis. So it's not just as easy as saying, what was my payroll for Q1? What was my payroll during the covered period? Oh, look, I did it. It's not that easy. It's granular. You've got to do it on an employee by employee basis. And this is the test that you're going to have the most amount of man hours in, right? So my wife's an accountant. Her organization got this loan. She's been working pretty much full time on just satisfying the forgiveness requirements, because you got to go employee by employee, doing pro forma calculations on what we think they should make, comparing that back to Q1, and seeing if they're going to hit it. So that's a note. And then one other note before we move on to the next slide is that the comparison to quarter one is somewhat simplistic. The act actually says that we are comparing that to the last full quarter of employment. So you've got more detail here, right? If you had somebody that had a baby and was on FMLA leave, paid time off for paternity leave, maternity leave, what have you, they might not have worked that full quarter in Q1. You might have to go back to Q4 2029, and it's on an employee by employee basis. So the actual standard is the last full quarter of employment. For most people, that's going to be Q1, but keep that in mind as you're doing the calculation too. Okay, so with the general rule, let's go on to the actual mechanics of how we think you should calculate this. So there's just so much uncertainty here, guys. I'll give you what we think the rule is, and then I'll tell you about the ambiguity and how we think it should work. So step one is you identify the employees that are employed during both the covered period and Q1. Throw out those people that make more than 100,000. Throw out the people that you've offered to rehire and they've rejected. So once you've kind of gleaned them, you've got your employee pool that you're looking at. Calculate their total wages for Q1 and then multiply this amount by 8/13 to annualize it. The reason 8/13, this is the Mike Zahrt version of this calculation. There were 13 weeks in Q1. There are 8 weeks during the covered period. If we're comparing apples to apples, you multiply by 8/13 to get the annualized number. So that's kind of 100% pay during the 8-week period. And then for each employee, you can multiply that result by 75% to give you the minimum that you can pay each employee during that covered period to avoid a reduction in your loan forgiveness amount. Now for the obnoxious amount of ambiguity. If you look at the plain language of the statute, it's just comparing Q1 to the covered period. It doesn't call for making it apples to apples. It doesn't call for any annualization of pay amounts. Just what did you make during Q1? What did you make during the covered period? That's it. We don't think that interpretation makes sense, because to make it the same, you'd essentially have to pay all your employees like 9.5 weeks of pay or something like that during the 8-week period just to get them to be the same. And the purpose of the statute is to get people back on payroll and back up to their old pay levels, not to bonus them. And it was specific guidance that says it's not meant to be a windfall, and that would be a windfall. So we don't think that makes sense. We think to make it apples to apples, you have to annualize. How do you annualize? I don't know. I use 8/13 because it's on a week by week basis, but maybe you can do it month by month. Maybe you take your Q1 payroll and divide by 2/3 and you've got it. We don't know. We need more guidance in this area. So just keep that in mind. It's an open issue. Maybe you use 2/3 just because it's a bigger fraction and you'll be spending more dollars on payroll. But in the event they say, yeah, it's actually 8/13 instead of 2/3, you've got some wiggle room. It's an area of uncertainty. One other area of uncertainty is who you have to pay. So again, looking at the plain language of the legislation, it looks like if they're on payroll in Q1, you've got to pay them during the covered period. And this is where I just get enormously frustrated, because I think this is the interpretation of the rule that makes the most sense. But when you go down this particular rabbit hole, you reach just completely nonsensical results, right? So if you've got somebody that retired during Q1, and doesn't work for you anymore, or they just quit or whatever, they've got a new job, the plain language seems to suggest you've got to pay them during the covered period because they were on payroll during Q1, even if they don't work for you anymore. That doesn't make sense. I mean, if you take it to the extreme, right? I catch somebody embezzling on March 30th of this year, and I can them, and I've got great cause because they've been embezzling. You mean to tell me I've got to pay them during the 8-week period to get full loan forgiveness? I mean, it makes no sense. I do not believe that that's the intent of Congress. The issue is that, you know, how risky do you want to be? How aggressive do you want to be in spending these loan dollars? And, you know, the purpose of our webinar today, if you're trying to ensure full loan forgiveness, I think the best practice for those employees that aren't with you during the covered period, that were with you during Q1, is to make the calculation. Determine what it is that you have to pay them. What is that minimum amount? What's the 75% on an annualized basis? And just kind of earmark it. You don't have to pay it to them right away, right? You've got the full 8-week period to give it to them. If you wait until, you know, week 7, day 6 and cut them a check, so be it. You've satisfied test 2. But don't spend that money on other things either, right? So you just kind of earmark it, set it aside, hope the government issues the rule that we think is the common sense rule. And if they do, great, you can spend that money on other things. But what we don't want to do is over rely on the government to make common sense rules, because that hasn't happened so far. And you go and spend that money on other things and we never get the common sense rule. And maybe you did have to pay that person and the money's gone. So that's bad too. So that's I think the biggest point of ambiguity here, other than just how do you make this apples to apples, what do you do with the people that aren't here anymore? I think that's the most reasonable approach. Keep that in mind. If you've got, you know, kind of fact specific questions, I've had just tons of conversations on this test the last few weeks. So Taylor has too. Either one of us are a good resource for you there. So with that in mind, I guess let's move on to an example, a very simplified example to see, you know, how this would work. So we've got all of our people here. I don't know how Taylor ended up making more than me, but I guess that's fine. But we look at what our 2020 Q1 numbers were, and, you know, we do our conversion. We multiply by 8/13 to kind of make this an apples to apples comparison. So that's the kind of fourth column you've got there, the 8-week equivalent pay. And then you take that number, multiply it by 75%. You see in the last column there, the minimum amount of money you can pay people to avoid a reduction in loan forgiveness. So I made, you know, let's call it $15,000 during Q1. The least I can make during the covered period is this $6,923.08 number. If they were to knock me down to $6,823.08, they reduce my pay by $100, and my max forgivable amount would be reduced by $100. So if we work for that company we talked about back in example 1, we're already down from 350 to 280 because we didn't bring in back enough FTEs. And if they reduce my pay by $100 below the number in this last column here, it's going to reduce that by another $100, right? So this is where the tests operate independently, and you can kind of get double dinged if you double fail. So, you know, this is the most simplistic analysis for most people. You know, if you're kind of operating anyway, right, this is kind of easy because you know what people are working, you know what you expect them to work during the 8-week period. You can kind of use the numbers that you expect to create a pro forma analysis, and you're probably going to have, you know, a handful of odd ducks that are maybe working reduced time that you've got to gross back up. So, you know, what's that look like? Do you pay them hazard pay? Do you give them a bonus? What do you do? You can do any of those things, really. The Act doesn't make a prohibition on hazard pay, so you can do that. I've got a couple nursing home clients that pay their nurses that are in contact with COVID patients. They pay them double. That's okay. Those are payroll costs, and so those people, when you apply test 2, are really satisfying test 2, right? And they pay other employees, you know, time and a half to go through PPE training. And that grosses up their total wage number, even if their hours are on a reduced basis. Now, this is where what Taylor was talking about, you've got some interaction between test 1 and test 2, right? You might not have sufficient hours compared to normal business operations to get those people working as many hours as they were. That's going to hurt your FTE equivalent number for those part-time people, even if you pay them hazard pay to satisfy test 2. So I may be paying these, you know, less than regular hour people hazard pay to pass test 2, and I'm still going to get dinged on test 1. You know, what do you do there? Maybe have them perform routine maintenance on equipment. Maybe you have them do some cleaning. Maybe you find some other tasks for them outside of the normal job description to get those hours back up where you need to be. But this is where you can kind of see the push-pull. There's an interaction between the two tests, but they also operate independently. So even if you've got one satisfied, you've got to be careful to make sure you've got both satisfied if your goal is full forgiveness. I think the tougher thing for people is going to be the folks who are closed, right? I mean, I think about like hair salons, right? If you employ people in a hair salon and the governor says you can't work, if you want loan forgiveness, you've got to pay those people to stay home. Maybe they're better off unemployed. I've had a few people who have gotten these PPP dollars and said, you know, the executive order doesn't let me be open. I can do what I need to do on a limited basis myself. My employees are better off on unemployment. And I think there's going to be the V-shaped recovery, right? Where once things open back up, it's just going to be business as usual. And I'm just going to give this money back. I think that's a reasonable position because your alternative is paying people to stay home if you legally cannot be open to work. And those are kind of your two options here. And it's unfortunate, but it's the way the act is, right? We have, you know, the federal government telling us when we have to spend these loan dollars and state governments telling us what can and can't be open. And you're kind of at the mercy of those two. So once you get your money, your 8-week window starts. If the governor says you can't be open, you've got to spend the money anyway. So if you want to keep it and you want full forgiveness, you're paying people to stay home. That's unfortunate, but that's the nature of the beast. So before I get too much more upset about this test, we'll go on to test 3. If you've got questions on test 2, please put them in the Q&A. Please shoot us an email. There's tons of ambiguity here, but we're sneaking up on 11. So let's keep going.
All right. Yeah, I think we all agree that that's probably our least favorite test. So let's put that behind us, at least for the next, 10, 15 minutes. The 75% test. We've broken this down into two parts, and I think it's a really useful way to think about it because it's a bit of a nuance on this that a lot of employers out there are not necessarily thinking about. And at the same time, I think probably the test that I am initially getting the most questions about seems to be the 75% test. And I got to say that if you come to me asking about the 75% test, we're going to talk about it, but I am probably going to ask you about your other two tests because it basically indicates to us that one of the other tests has an issue. Because if you satisfy the other two tests, you're not going to have an issue with the 75% in general. I haven't run into it, at least. I haven't done the mental gymnastics yet to think through whether it's even possible. But in any case, the point here is really think closely about whether if you're coming to us with an issue on the 75% issue, whether that really is a bigger issue under those other two tests. And we've got two requirements. The basic requirement is stated as we have to spend 75% on our payroll costs. Of 75% of the loan proceeds must be spent on payroll costs. And Mike talked about payroll costs. We walked through what those are. And in general, that includes quite a large number of items. Remember that includes far more than just our salary and wages. That includes employee benefits. That includes some tax-related items. And so we really want to remember, I've had a few issues, I suppose, where the real underlying issue here on the 75% test is actually that we're being a little too conservative about including costs and not including everything on payroll costs. So that can be helpful. And that's a good, if there's any outcome that we like to realize, that's probably the best way to fix it, is that we just haven't been thorough enough yet on including all of our payroll costs. But the important nuance here, and the two bullets that we have breaking it down, are really a matter of timing. And we want to think about whether we're spending 75% of loan proceeds during the covered period, that 8-week period after the loan proceeds are deposited, whether 75% are used on payroll costs. And that's, the other 25% can be used on, those other permitted forgivable expenses. If we're talking about loan forgiveness. In general, you can use them also on those pre-existing debt obligations without running into an issue in terms of, overall 75% rule, but we're gonna have an issue on loan forgiveness if we're talking about those pre-existing debt obligations. But that 25% does include those in general. But for our employers who are going beyond the 8-week window and retaining some funds, or we're having a reduction in our forgiveness amount and we've got some money left over maybe at the end, we want to think about 75% of the total loan amount being used on payroll costs just in general at the end of the day once we're doing a final accounting of how the whole thing was used. But that can give us some flexibility potentially, maybe during the 8-week window, we just know we're going to have money left over based on how some of the numbers have worked out. We've got some employers that's just a fact of the matter. And, maybe during the 8-week window, we've basically spent it all on payroll costs and we have no problem with 75%. Now we actually have some wiggle room on the back end after sure we have a 1% interest rate loan, but at least the ability to use that is now opened up because we only have, we've more than satisfied our 75% on the overall on the front end. If we have an issue with this, think about our other 2 tests. Again, don't forget that payroll costs are more than just compensation. There is a built-in window here that if we've reduced employee, salaries or wages in light of, just the business has hit hard times and it makes sense, we're going to reduce wages. Plenty of employers have done that. You might end up with an issue in both this test and also one of our other, or one or both of, one of at least the payroll cost or the wages test, basically the test 2 that we just talked through. You can do that, but in that we have that 75% reduction, kind of number in there, but let's just think about whether that reduction is useful once we get down to the 75% test. And we also talked about that cash or accrual issue. If we have an issue with the 75% test here, maybe we consider, whether we want to prepay some items. But again, if we're taking the cautious approach, we might, we might think about whether that's our best option. It's a little unclear in terms of whether, some of these items are both accrued and paid. If, for instance, we're generating an invoice that we don't usually pay this early in the year, does it relate to this 8-week window? There's a whole host of questions on that and whether we can do it. And so I would just encourage you to really think about that and contact us for your specific kind of circumstance if you have questions. I'd also, I'll open this up. I have a bit of a question here. I'm curious, not to put Mike on the spot, but as I have looked at this test, I don't view this necessarily as purely a loan forgiveness test necessarily. There's a bit, I think I see at least a bit of an open issue as to what the outcome is on not meeting the 75% test.
Right.
So we've had some conversations at least with some clients as to, well, what happens if I don't meet 75%? And I'd say although the underlying issue might be another test, this one could actually be a much bigger penalty or a much bigger outcome potentially. Right. We might be talking just about loan forgiveness and not hitting the 75% number. We might be talking about anything up to even misuse of loan proceeds, which gets into a really sticky outcome. Mike, your kind of takeaway on that?
I agree. I mean, the slide sets it forth pretty well. It's a 2-part test. So you got to use 75% of the loan, whatever you spend during the covered period, 75% of that's got to be on payroll costs. Again, look back at our definition of payroll costs. You can pay new employees, you can pay hazard pay. It's independent of the first 2 tests, but 75% of that's got to be payroll costs. But then, and this is where it's tricky, because in the interim final rule that gives us the 75% test, these 2 prongs are like 5 pages apart. They don't state them in the same paragraph. So early on, it says 75% of the loan proceeds during the covered period have got to be on payroll costs. Later, it says 75% of the total amount has to be on payroll costs. And that's why we think it's a two-part test. So if you get $1 million loan, you spend $500,000 during the first 8 weeks and hit the 75% test on that $500,000, fine. You'll get loan forgiveness up to $500,000. If you get 74%, I read it as an all or nothing. If you get 74%, you don't get, that fraction of 75% loan forgiveness, you're out of luck, right? So you got to hit the 75% number. But if you do, you get $500,000 loan forgiveness and a $500,000 very cheap line of credit. But if during the period after the 8 weeks, you don't spend a grand total of $750,000 on payroll costs, now all of a sudden your total loan proceeds, right? 75% of the total loan proceeds have not been used on payroll costs. And that's kind of this big cliffhanger that Taylor mentioned. And I agree. I think if you don't hit both of those prongs, especially if you're going to use part of it as a line of credit afterwards, you could potentially run into some sticky issues of misuse of loan dollars and subject to those nasty penalties we see on the news.
Yeah. So we're gonna. I know we're hitting kind of our top of the hour here. We're gonna kind of quickly move through the last couple of slides. We'll try and hit a couple questions and wrap things up here.
Yeah. So I'm gonna blast through these last 2 slides here and give Taylor a chance to kind of screen some questions. I see we're up to 189 questions and 45 entries in the chat. So there's just there's no way we're gonna be able to get through that. We'll try to get the ones that have the quick answers, and if we don't get to yours, we're sorry. Please send it to both of us. We'll make sure we answer everybody's questions. It just might not be during this webinar. You will get a recording of this webinar. You'll get the slides, so you'll have all that to look back onto. One more note on the 75% test. Again, I think if you flunk it, you've got an issue with test 1 or 2. Because if you think about when you applied for the application, you use 2.5 times average monthly payroll costs. So if you think about that on a weekly basis, you got a loan for 10 weeks of payroll costs. The covered period is 8 weeks of payroll costs, and the 75% rule only requires you to spend 7.5 weeks of payroll costs in an 8-week period. So thinking conceptually, just at that very high level, if you can't hit the 75% number, you've definitely got issues on test 1 or 2, right? Because just the way the formula works on the application, payroll cost is the same defined term. If you can't hit 75%, you've got a test 1 or test 2 number. Just keep that in mind when you think you're not going to have enough for the 75% test. You're either not defining payroll costs broadly enough, or you've got a test 1 or test 2 problem. Applying for forgiveness. I'm not going to read you this whole slide, but just think about the mechanics of this, right? It's your bank that makes the loan. It's your bank that you apply to forgive the loan. And when they forgive it, they go back to the SBA, and the SBA pays them the difference. That's kind of the mechanics of how this works, right? So whatever the banker was that made you this loan, he or she are the people that are going to give you the loan application once they have it. They don't have it yet. But they're the people you'll be working with. We've got all the documentation requirements that we have so far laid out. We hope to have more. What I tell people is do it in real time as you pay it. More documentation, the better. We'd rather have you have a whole stack at the end and you don't need it all than to get to the end and have to go back and recreate the wheel. So do that. You also want to structure your documentation, right? And I don't mean like cook the books. I mean, do it accurately, because otherwise, there's steep penalties if you cook them. But you want to hold their hand, right? Because these lenders are going to have a ton of these. Think about the flurry of activity we had during eligibility. We got all this funding at the same time. All these loan forgiveness requests are coming in at the same time. You want to hold your banker's hand and put that in a nice, neat package that says, look, here's step 1 and here's how I satisfied it. Here's a file with my documentation. Here's step 2. Here's how I satisfied it. Here's the backup information. Same thing for step 3. So they can kind of walk through it step by step and say, yeah, this is clear. This is easy. You've got your backup information. And hopefully they just rubber stamp the thing. They're going to be motivated to get it off their books, right? Because it's a liability for them too until the SBA forgives it. So there's going to be this kind of second flurry a few weeks from now. But you want to make it as easy as possible, and we can help you with that. Absolutely. So just be thinking about that. Be mindful of that as you're preparing your documentation. I won't talk about
just one note that I would just jump in on too is if we're, we've got we've got kind of employers at different stages in this 8-week window right now. we've got some who are just receiving their loan proceeds, or maybe haven't even yet. You know, we've still got some budget out there on the PPP. So if you're just receiving, or you're not, you know, on the back end and starting to think about that application, which we don't have, you know, really projecting outward, projecting ahead, projecting the rest of your 8-week window right now. Now that we're talking about loan forgiveness, where you can see kind of, you can conceive of what this is going to look like on the back end. And obviously it's going to be helpful to have your documentation in line. And right now, if we start putting that together, and if we're projecting forward and what we expect our employment levels to look like, and our wage and salary and kind of payroll costs, you know, to look like, we can make some, you know, strategic decisions about how to, you know, use these loan proceeds to make sure we're within these calculations, within these rules. And that is, you know, having that conversation right now and walking through the model and whatever we can do to project out is probably the most important thing you could be doing right now. Because if you haven't run those numbers and you don't know whether you're within the calculations, you're running a bit of a risk as to for both forgiveness and, like we said, that 75% number has potentially a significant cliff that we could be running up against. So just, you know, I don't want to belabor the point, but I just want to mention that we're having a lot of these conversations, walking through clients with, you know, on their kind of loan forgiveness models. And if you need any help with that, please reach out.
Absolutely. Yeah, I had one just yesterday. Joe, I think Joe's actually attending, and we did a Zoom meeting. He shared his screen, he had his Excel spreadsheet up, and he kind of walked me through, you know, here's what I'm thinking for all these tests. And it was just a good opportunity to say, yeah, I think you've got the concepts right. And that's the first most important part. And then, you know, step two, the value add is, you know, let's see what we can do from a proactive standpoint to make sure that we're, you know, really maximizing the value of these loan dollars. Okay, let's move on to the dreaded full audit. I wanted Star Wars Imperial March for this, but I'm just not tech savvy enough. So I'm sure you've seen the headlines for this, the dreaded full audit. I'm not going to talk too much about this because at this point it's all speculative. I've talked to bankers. I've talked to in-house counsels at very large banks to see if they've got any inside information on this whatsoever. And nobody does. I mean, it's just, you know, if you're over $2 million, you're going to have a full audit. So I guess some things to consider. I did some research on this. There are roughly 26,000 PPP loans that are north of $2 million. So just think about it in terms of, you know, does the IRS and the SBA have the manpower to, you know, physically audit 26,000 loan files? I don't think they do. So I think what this is probably going to look like is a triple check of your loan forgiveness numbers initially. You know, you're going to have to do the math. The bank is going to double check that math when you apply for loan forgiveness. They're probably going to double check your eligibility. And then for these large loan files, they're going to forward them on to Treasury and they're going to triple check the numbers. For the smaller files, maybe they don't decide to do the manpower on that unless there's something extra that flags them. That they will certainly commit manpower to it as much as they have, right? I mean, there's kind of a public outcry to that. So I'm not saying go ahead and feel aggressive because all you got to do is beat the computer. Don't do that. But, you know, just practically speaking, I don't see how they've got the manpower to do this. I think who they're going to be targeting goes right back to what we talked about at the beginning, the certification requirement. You know, do you have enough liquidity? Do you have access to capital markets? You know, I mean, I think they're going to be targeting the Ruth Chris's of the world and the Los Angeles Lakers of the world, right? Some of these people who have already given their money back, the folks that haven't. There are 220 some publicly traded companies that have PPP loans, and to me, the guidance seems to say that if you're publicly traded and you don't give it back, expect a full audit. So that's going to eat up some manpower right there. But, you know, if you think you're a big fish because you've got a $2 million loan, there's 25,999 other people just like you out there. So I guess what I'm trying to say is, you know, take it seriously, make sure you get your documentation requirements right, but don't lose sleep at night over it either. You're not going to have an agent in your building the day after you apply for loan forgiveness. I don't know, Taylor, do you want to add any more on that? It's pretty speculative at this point.
Yeah, I agree. I think it's very speculative. I think the most significant penalties out there are going to be the most egregious situations. That much is clear. I saw we had the first we've actually already got the first case working its way through, I think, the courts where they're prosecuting fraud on one of these. And it was a situation where it was essentially a non-existent company, or a company that really hadn't been operational in quite a long time, and clear fraud, clearly a terrible, there's no way that person should have been applying. It was some business out on the East Coast that had been dormant for a real long time. So, clearly don't do something like that. The more, I would just say, the more public your operations, there's a little bit more of a risk factor there. We've also had employers who have been really public initially about, hey, we received this is great. We're really excited to be able to pay all of our employees, and we're really thankful for this. And that, to me, that's a great message. I think it's really positive. If you haven't done, if you've already, if the cat's out of the bag, I think that's fine. I don't think it's necessarily a huge risk, but one thought this might be, if you've only recently received it, if we haven't communicated to employees that this is why we're able to continue paying them, maybe we don't mention that it's because we got a PPP loan. I don't think we're trying to hide anything here so much as kind of control the message a little bit. And, it's just the way that some of the messaging on this has gone has been interesting, and it's tough to project exactly what that's going to look like is all.
Mm-hmm. Yeah.
So
I guess
something to think about.
Before we get into questions is, satisfying, especially test 2. We kind of talked about it previously. If you're self-employed, don't make a huge contribution to your SEP. If you want to gross up that payroll cost number for some reason, I think they're going to be looking for outliers, right? When they're looking at, here's what this employee made during Q1, and during the covered period, they made 300% more. And they just happen to be the son of the owner, and he's sweeping the floors, right? I mean, that's the kind of stuff that they can flag with a software program and then have somebody go back and double check it. So I think if you have a reasonable good faith basis from the outset, and it's just based on economic uncertainty that you need this loan, and then you jump through these forgiveness hoops in a reasonable and conservative fashion, just like we've laid it out here. You set the groundwork nicely for your banker, and he approves it. If you get through all that process, I don't think you should be hugely worried about even being audited in the first place. But if for some reason you are audited, I still wouldn't be that concerned about it. I wouldn't lose sleep at night if you weren't, making up fake employees, if you weren't bonusing out grandkids, if you're just operating a good business model. And the gloomy picture we had 6 weeks ago when this program first came to light, never actually happened, I don't think you're going to be subject to that much scrutiny. So I guess that's, if I can make you feel warm and fuzzy, that's my best attempt at it. We got a few minutes for questions. Maybe we can run a bit over. I don't know. I don't know how hard the hard cutoff is, but
yeah, I'm just scrolling through here, and again, Mike mentioned it. We've got hundreds of questions. We're gonna flip through some of the quicker ones here, and hopefully help on some of these points. But I'll also say I see a lot in here that are just particularly fact specific. So if you're concerned about specific numbers, just real strongly recommend that you give us a shout, email, or a phone call. We can set up a time to talk. So you'll be able to get the slides. By the way, I also saw a number of questions just asking about that. But so for instance, is forgiveness all or nothing, or is it a partial forgiveness reduction available? It is. So it's partial forgiveness reduction. When we're talking about those 2 tests that Mike and I walked through, in both cases, you end up with a calculation that reduces it either by, a particular percentage, or a dollar for dollar, potentially sort of an amount based on how much employees are paid, which is itself, a ratio. But in any case, you have a specific amount that you're subtracting off of the top of the loan forgiveness amount. And unless we have really kind of gotten into a problem on those 2 forgiveness amounts, we're going to end up with some level of forgiveness in, I think, the vast majority of cases that I've seen. Unless, if we, totally haven't brought anybody back on payroll, and we, I guess, that could be an issue. But in general, you'll end up with partial forgiveness reduction. Mike, feel free to jump in here.
Yeah, no, I'm looking at a lot of these, and I think we covered a lot of them in the context of the slides. Maybe the questions came in before we got to them. But if for some reason you think that we didn't get to them, obviously feel free to come back and chat.
Yeah, I'm seeing a number on.
Will forgiveness amounts be taxable income? No, they will not be taxable income. That is clear in the CARES Act. I see a lot of this stuff about, and we should have covered this. I do get this a lot. It's this distinction between, layoff and bringing people back to work and paying them even if they're not working. So if they're an employee, if they're getting a paycheck from you, they are no longer unemployed. They are not laid off. They are back from layoff. So they cannot double dip. They don't get the extra $600 federal perk if you're paying them to stay home. Even if they're not working and they're just staying home, if they get a check from you, they're not laid off. They're an employee. I think all bets are off after the 8-week period. If we get to the end of loan forgiveness, you apply and whatever else happens, you want to lay them all back off again, go ahead. We haven't, it's kind of counter to the act, but we haven't got anything in the act that says that you can't do that either. So that's important.
Yeah, I'm seeing also a number here that get us back to that certification question. Mm-hmm. And, we did cover it, but, I'll give one example here. We've got, one question about it, if you are continuing to operate to some level and you're continuing to receive some revenue, should we be concerned about, forgiveness issues, or should we be concerned about, I think that this relates also to heavily to that certification as well, because we have offsetting revenue. I don't think that revenue and income and being able to operate at, reduced capacity is going to be a particular concern on the loan forgiveness issue, but I do think it raises a question as to the certification. And I think that's the question that we've been fielding ad nauseum over the last several days and weeks here. And that's, depending on the level of what we have and what was expected on the date that we made the loan certification in the first place and filed our loan application and agreed to take the funds. That's if we expect it to be partially operational, let's have the discussion and let's paper the file if we decide to keep the loan proceeds. That's, my recommendation on a lot of these specific questions in terms of how much, we thought we'd be 80% up to normal, or we thought we'd be 20%. Does that impact us? Really strongly in those cases recommending a conversation here and recording our reasoning as to why we were eligible. Okay, well, we're a bit over time here, so I think unfortunately we've got to cut it off there for the 226 of you that have questions posted. I do apologize if we didn't get to it. This is a thorny topic. Again, we've got both of our emails up here on this final question slide. I have no problem having 226 new emails to sort through this afternoon. So please do ask those questions. We will be recirculating this meeting afterwards. It'll be sent to the email address that you used to register. The slides will be available too. I think just based on some of the questions I see rolling in, it might be helpful for Taylor and I to come up with a resource that presents it in a format other than PowerPoint. So we'll put our heads together on that too and see if we can't come up with something that might at least knock out some of the low-hanging fruit for you. But thank you for all of you who attended. And we had 800 to start and we still have over 600 and we're over time. So thank you for sticking around for an hour and 20 minutes. We appreciate that too. Taylor, anything else to add on your end? No, just good luck. Keep abreast of the rules here. Keep an eye on kind of the news. We absolutely expect additional guidance on this. It's changing every day. So it's just strongly recommend keeping abreast of all this and doing what we can. Absolutely. Thank you, everybody. Thanks, everybody. Have a nice day.